You were just in Asia. You know, we were just talking about China a second ago. You know, the Chinese government, in order to sort of hang on to this expansion, or at least to limit the downside of it, has been expanding the money supply. How often can they go back to that well?
I think not very much. You know, I think the important thing that I'm thinking about is, you think about it, the last 5 years, what do we know? When the Fed did QE, the dollar collapsed. When the BOJ did QE, the Japanese yen collapsed. And then when the ECB started QE, the euro has collapsed. The Chinese now trying to do their own version of QE, and yet they don't want the renminbi to go down. So all this liquidity is pouring into the stock market. So I think from that point of view, this is how we need to basically see it. And the question in some sense is that 2 years ago, when the new prime minister president came into power, they said that, you know what, we need to basically keep the housing bubble under control, because otherwise, you know, this is going to end very badly. Guess what? 18 months later, the housing bubble is still there, except they now have a basic stock market bubble as well. I think they're in a very weak position.
For Americans, it is one of the not exogenous shocks, but certainly outside the realm on this Fed day. Another one is Greece, and we've got great challenges here with Greece. What is your new take? I mean, Gilles Moek and others with Bank of America, Merrill Lynch, have said it's moving forward, it's moving forward. Has that unraveled in the last 2 days?
You know, Tom, I think the way I think about this, most people think, well, there can only be one of two outcomes when it comes to Greece. Either they're going to come to an agreement in the last minute, or there won't be an agreement, there will be Grexit. I think there's a third scenario that's presenting itself. It's becoming increasingly more likely, which is basically a gray area that they basically impose capital controls, they default, but they don't exit the euro.
Okay,
and then you go through months and months of basically messy deals.
I will go with that. Here's the rate of change, folks. In the 2-year yield, we've gone from 22% to 30% in a matter of days. You know David Wu, the Bloomberg terminal that does the volatility surface. I've never seen euro 1 week, 1 month volatility where it is versus the quiet of the future. I would suggest the market vigilantes are betting something happens soon. Do you agree with that statement?
Yes, but yet at the same time, I don't have to tell you this past 3 days, the euro has been trading like a baby. It hasn't been able to break down.
Please explain why vol is elevated, but the euro trades like a baby.
The reason is because, just think about it, in the last 5 years, you know, people who traded through the debt ceiling crisis or the first European crisis, people who shorted basically policymakers end up basically getting their fingers burned, because the last minute they always come to an agreement.
Yeah.
So this time around, the market simply are too afraid. And yet I think the writing's on the wall that there is no agreement, and it's too late for them to come to an agreement.
David, when you look at what policymakers are saying right now, do you feel like they're acting rationally?
I think they're acting rationally relative to their own, basically, reaction function. The Germans are acting rationally because they know that basically the public is totally against any debt forgiveness. And then I think, you know, to some extent, the Greek government is also acting rationally because they think by acting the way they are acting, they might force the other guys to basically finally capitulate. And this is why there's no agreement so far. But again, as I think before, it could be a default capital control but no exit might actually increase the leverage that Greece has.
How does that work? No exit from the euro but capital control. So this is Cyprus. How long can they do it? They're a bigger economy than Cyprus. Do we have a precedent?
The point here is that they're now running a small current account surplus. They're also running a small current, basically budget surplus. So if they don't basically pay interest, okay, on their debt, guess what? You know what? They might be able to keep it going for a while. I think all at this point is about trying to gain an advantage. There's no question that Greeks until now didn't have any advantage because they didn't have any leverage. But I think actually by defaulting, they could actually gain a little advantage from a game theory standpoint.
There are two schools of thought here. I'm going to put you and Alan Ruskin of Deutsche Bank in one camp, which is there's real knock-on effects here from Greece. There's another group that says, no, this time is different. It's not going to be a big deal. I'm looking at my Bloomberg screen, which tells me there is a contagion factor here. What have you learned about contagion in the last 2 days? And, of course, this is Mr. Tsipras speaking literally. I mean, I don't know. Who's he going to tear apart today?
And the governor of the Bank of Greece out today saying, you know, it must be averted.
So what is a contagion update when I look at my screen and it says contagion's there?
because exactly, I think there will be contagion because the reason why, the European stock market is still up 10% year to date. The reason why, according to our own proprietary flows, most U.S. investors still overweight European equities. The reason is because they think this thing is going to basically either reach a happy ending because they're going to come to agreement, or they're just going to leave the Eurozone. It's going to be a clean exit. If my scenario is correct, that we'll go through this protracted, ugly divorce, I think this is going to basically force people to reassess.
Then the money question here is, with the heightened vol and the lack of liquidity in euro, do you see a jump condition of the euro towards parity? And even as Mark Chandler at Brown Brothers suggests, through parity?
I mean, through parity is a bit aggressive. I'm definitely forecasting parity still. I still think that basically this Greece thing, I think that should driving lower euro, but also ECB QE. Let's not forget in July, only 2 months away from July, when the negative supply of European government bonds after ECB purchases is going to be 105 billion euros. 105 billion euros of negative supply of European bonds. That's an annualized rate of 1.2 trillion euros, 1.5
And it's not equivalent. It's much more than what we saw in the Fed. On
absolutely, and that's going to drive down the euro, I think.
Okay. Next time we'll have David Wu more wound up than he is right now.